Welcome back to Reg Talk UK, the podcast that helps UK banking professionals stay sharp, stay informed, and stay ahead of regulation. I'm Alex.
And I'm Jamie.
So, if you glance at any news feed right now, it is just wall-to-wall coverage of the two kings' state dinner in Washington. King Charles and Donald Trump.
Right. Pure geopolitical theater.
Exactly, yeah. Diplomatic toasts, carefully choreographed photo ops. The pageantry is fine, but the bill is not.
No, it really isn't, because while the cameras are fixated on, the East Room menu, UK risk committees are staring down a genuinely alarming set of conditions.
Right. We're talking Brent crude at $126 and rising, a tariff-driven inflation threat, and honestly, a domestic regulatory calendar of unusual density.
Yeah, it's a structural earthquake happening quietly in the background.
And just to set a boundary for you, the listener, right up front, the sources we're unpacking today, they cover some heavily charged geopolitical catalysts. Trump's tariffs, UK diplomatic positioning, the U.S.-Israeli conflict with Iran.
Yeah, and we need to be clear, we're looking at this strictly through an economic and regulatory lens. We aren't taking sides or, endorsing any political viewpoint.
No, absolutely not. We're just here to follow the money, track the regulatory response, and break down the financial impacts reported in the source material so you can navigate these turbulent waters.
Let's start with the macro picture. The Bank of England.
Right, so they recently held interest rates at 3.75%. But here's the thing. They aren't just issuing standard forecasts anymore. They've mapped out three, they call them thought experiments.
Yeah, thought experiments regarding the Iran energy shock, which frankly matters a whole lot less to a central banker than it does to a mortgage arrears team dealing with the fallout.
Spot on. Because scenario C is the one that really sets off alarm bells. If oil stays above $130 a barrel, the model predicts inflation pushing to 6.2%.
Which is a massive spike. And that would force peak rates up to 5.25%.
Right. And what's terrifying is that Brent crude has already hit $126. Scenario C isn't just some abstract whiteboard exercise. It's uncomfortably close to our baseline reality right now.
Exactly. And then you look at the domestic dashboard, and you get this bizarre disconnect. The UK labor market data dropped, and headline unemployment unexpectedly fell to 4.9%.
I mean, 4.9% looks fine, right? Like a warning light on your dashboard that's turned off. But underneath the bonnet, the engine is completely stalling.
Yeah, it's an illusion. It is entirely driven by a massive rise in economic inactivity.
So explain the mechanics there, because if unemployment drops, usually that's good news.
Well, not if people are just giving up. If you stop submitting CVs, you vanish from that 4.9% statistic. Yeah. The inactivity rate is now sitting at 21%.
21%.
Yeah, a huge chunk of that is just students dropping out of the job hunt entirely. And at the same time, actual job vacancies have hit a 5-year low down to 711,000.
So the demand side is freezing.
Exactly. And the IMF just slashed the UK growth forecast to a mere 0.8%, explicitly citing our vulnerability as a net energy importer.
So the takeaway for you, if you're managing consumer credit resilience, is do not let that headline 4.9% figure lull you into a false sense of security. The ground is shifting.
Which brings us to a massive, frankly surprising regulatory pivot from the PRA.
Yeah, the Prudential Regulation Authority. And this is where it gets interesting, because with all those macro shocks on the horizon, you would naturally think regulators would be forcing banks to hoard cash, right?
I think so, yeah. Build the fortress.
Right, but David Bailey, the PRA's executive director for prudential policy, he gives this landmark speech. And the Financial Policy Committee is actually cutting the Tier 1 capital benchmark from 14% down to 13% of risk-weighted assets.
Which is a huge release of capital across the sector.
Okay, let's unpack this, because on the surface, lowering capital requirements right before a potential 6.2% inflation spike, isn't that like unbuckling your seatbelt right before a car crash?
It sounds reckless, but it's actually about buffer usability. The post-2008 era of just building impenetrable walls of capital for the optics is over.
That was the old glass case analogy. You have a fire extinguisher on the wall, but banks are too terrified of market panic to actually break the glass and use the capital during a crisis.
Exactly. They hoard it, credit freezes, and the real economy burns. The PRA is explicitly nudging banks to actually use their capital cushions. Deploy it. Lend to the real economy during stress.
So it's a shift toward agility.
Yeah, a regulatory spring cleaning, really. We're seeing it everywhere. The Future of Banking Data Program just axed 37 underutilized reporting templates.
Which compliance teams will absolutely celebrate.
Right. And they're shifting away from those rigid, firm-specific 15% loan-to-income limits to a broad system-level monitor.
So they're easing up on the broad benchmarks, giving banks flexibility. But there is a flip side to this prudential pivot.
Oh, absolutely. They are aggressively targeting specific structural risks hidden in the plumbing.
Funded reinsurance.
Yeah, Gareth Truran laid this out clearly. The bulk purchase annuity market has exploded. Life insurers are taking on massive pension liabilities and passing the risk onto global private credit markets.
And the capital held for these transactions right now is, what, barely 2 to 4%?
Exactly. It's an arbitrage loophole. If the private credit market defaults, the contagion snaps straight back to UK pensioners.
So Truran is closing the gap.
Yeah, they plan to enforce a standardized counterparty default adjustment of around 10% by October 2026, stripping away the illusion that risk just magically disappears offshore.
Okay, so that's the macro and wholesale side. But let's shift to the consumer side, because the FCA is having its own pivot moment.
CP2615, the death of the small print.
Basically, yeah. The FCA is finally admitting out loud that nobody really understands the small print. They are proposing stripping back those highly prescriptive CONC3 rules on financial promotions.
They're specifically questioning the 51% Representative APR rule.
Okay, but wait. If you get rid of strict formatting rules for APR, doesn't that just give predatory lenders a license to bury their true costs behind slick UI?
You'd think that, but the FCA's behavioral data proves the opposite. Prescriptive rules force firms to design disclosures that technically tick a regulatory box, but psychologically confuse the consumer.
So it's an optical illusion. You see low APR, but because of compounding and loan duration, it's actually the more expensive option.
Right. So under the consumer duty, the FCA wants an outcome-focused approach. Firms need the flexibility to show total repayment costs in ways that actually help people understand what they are signing up for.
Agility over rigid formatting.
Exactly.
Actually, before we move on to the domestic property market, if you're finding this useful, don't forget to follow Reg Talk UK on Spotify or subscribe on YouTube. It really helps us reach more banking professionals like you.
It really does. So let's talk about property. Because yesterday, May 2026, the Renters' Rights Act 2025 officially came into force.
A massive structural reset.
Huge. Section 21, no-fault evictions are entirely gone. Fixed-term tenancies are banned.
Bidding wars are restricted, and local authorities can hand out civil penalties up to £40,000. For tenants, this is fantastic security.
Oh, brilliant for tenant security. But for lenders underwriting buy-to-let mortgages, it fundamentally changes the risk profile.
Because the landlord's income is now rigidly locked. They can only raise rent once a year, while their costs, like mortgage rates, fluctuate wildly.
And if the tenant falls into arrears, regaining possession takes significantly longer now that they have to use the backlogged court system for fault-based evictions.
Right, which means longer enforcement timelines for the bank.
Exactly, and impaired recovery values. The old buy-to-let stress testing models are effectively obsolete as of yesterday.
Let's call this what it is. Everything is speeding up, and old models are breaking. And speaking of speed, let's look at the plumbing of everyday payments.
Bank of England working paper number 11,180.
Yeah. They confirmed that JPS volumes in the £250,000 to £1 million range plummeted by 10.7 to 13.7% right after the faster payments limit was increased.
Which proves a massive structural market preference. When given the choice, corporate treasurers and high-net-worth individuals will substitute away from traditional gross settlement.
They want instant liquidity. The speed of money is everything now.
But speed without accuracy is a liability.
Which brings us to the most entertaining yet terrifying anecdote of the week. The Sullivan and Cromwell AI hallucination.
A stark warning on tech integration.
We are talking about a prestigious firm charging up to $3,000 an hour, having to formally apologize to a New York court because they used an AI chatbot to draft a legal submission for a lawsuit involving Prince Global Holdings.
And the AI confidently hallucinated totally fake cases.
Just made them up. If an elite law firm can get caught out like that, imagine a retail bank using AI for dynamic credit disclosures under the new consumer duty rules.
Trust nothing. Verify everything. Because as the FCA staffs up its Regulatory Decisions Committee for Contested Enforcement, they are bringing in heavy legal firepower.
Yeah, let's do a quick round on enforcement and governance to wrap up. The FCA just appointed Jonathan Petty and Raymond Cox Casey to the RDC.
Which tells you they are gearing up for complex, contested fights.
Absolutely. Also on the regulatory sweep, CP2614 proposes scrapping the 7-day IPO delay for connected research publication.
Speeding up capital markets again? And a quick reminder on ESG rating providers have until 13 May to join the FCA's voluntary recording pilot.
Right. On the retail enforcement side, the FCA has charged Sean Lawrence for unauthorized mortgage broking.
And then there's the Wellesley collapse complaint. This is a rare bit of candor from the regulator.
Yeah, the FCA actually upheld a complaint against itself. They admitted that their 2014 authorization of Wellesley did not fully follow their own internal policy.
They issued a formal apology.
No compensation, though.
No, of course not. But admitting fault is a significant precedent.
So we've covered a massive amount of ground. From the BOE's $130 oil fought experiments to the PRA's 13% capital pivot.
The structural shock to buy-to-let, the death of the rigid APR, and the demand for instant liquidity.
It's all connected by a massive shift away from rigid prescriptive systems toward agile, outcome-based frameworks.
But here's a final provocative thought to mull over. Agility is fantastic, but it requires perfect situational awareness.
Right.
If our headline economic data, like that 4.9% unemployment rate, is actually masking a stalling engine, and if our most expensive AI tools are confidently hallucinating facts,
Then what are we basing our decisions on?
exactly. Are we building this flexible new regulatory era on a foundation of fundamentally flawed data?
If your dashboard is lying to you, it doesn't matter how fast the car is. Spot on. That's all from us this week. Thanks for listening to Reg Talk UK. Until next time, stay sharp and stay compliant.